Hello, everyone. It's Mark Sebastian, your only option, and this is Option Pit Rules the Road. Hey, I want to remind everybody, make sure you're coming to our website every day to check stuff out. We put out all kinds of content, and if you're not on our email list, you need to be on our email list so we can send you all kinds of goodies that we're putting out every day. Today, we're going to talk about implied volatility. And what I want to kind of educate you on is that implied volatility is created by the market. It is created by people like you. All right. So what is implied volatility? Implied volatility is what we think a stock is going to move in the future. Right. This is 30-day implied volatility. So this is guessing how much Amazon is going to move over the next 30 days. This is Amazon. So how do we get to this price? Well, it's just like a stock. All right. It is just like a stock. So I want to show you something. This is a market on the stock. Amazon, the market at the close was $32.89.51 at $32.90.80. So it's $1.30 wide. If I wanted to sell 100 shares of Amazon, I'd get $32.89.51. If I wanted to buy, I would pay $32.90.80. That's the market. Now, here's the key. Implied volatility is just like this. Now, when we're trading options, we have look at all these derivatives, right? They rely on the stock price, right? The model relies on the stock price. It relies on the strike. It relies on the timed expiration, things that are constantly moving. So how do we control all of these option prices? It's not like I'm in there manually changing all the option prices at once. I'm not. All right. So what do? I have this line. This is my implied volatility line for 30 days to expiration. And as traders are buying and selling options, I'm moving this implied volatility up and down. You can actually see it moving up and down and plugging that into my pricing model, which then produces the option prices. All right. That's the key. All right. Here's a tick chart of Amazon. I'm going to add in the tick chart of Amazon implied volatility for you to see. Check this out. This is a 1-day chart. Let me put a 2-day, 5-day. All right, here's a 5-day chart of Amazon. All right. And what it tells me is how Amazon volatility is changing, right? That one doesn't want to work. Let's use SPX. All right. So you can see these red lines and yellow lines and blue lines. Let's just look at the yellow. This yellow line is how I'm moving throughout the day. All right. Not just hour to hour, but throughout the day, minute by minute, how I'm moving volatility up and down as demand for option prices changes. It's key. And so then I'm plugging this movement in implied volatility into my models, which then produces the option prices. That's what I'm doing as a market maker. And when I see a lot of demand, I raise my implied volatility, which raises my option prices. When there's a lot of people selling options, I lower implied volatility, which lowers my option prices. So the key to understanding applied volatility is really the key to understanding a stock price. As a stock price goes up or down, market makers in stocks raise the price and make markets around it. As demand for options goes up, market makers raise that implied volatility, which increases option prices. As demand wanes, as there's more selling, market makers drop those prices. It's plain and simple. Implied volatility is basically how option market makers quote all of these strikes and months with one person, because we only need to really move around this implied volatility number that plugs into that month. You can see these sigmas. This is really the crux of everything I'm moving to stay ahead of the market. All right, folks, I hope you have a great weekend. Give us a call if you got questions. I'll talk to you soon. Have a good one.